So guys, today we'll take up with India's 12 income tax standard. As such, standard is not difficult, but if the base is not formed correctly, the standard will appear as confusing standard forever. So we'll take a little bit of time in building the base of this standard. Once that is done, rest of the standard will be very simple. It is not at all scary. It's a very simple standard actually, but the thing is the initial base should be very clear. Anyway, let's see. The standard title is income taxes, so we will be studying and learning accounting of all kind of taxes. Let it be current tax, let it be deferred tax, any kind of tax, let it be dividend distribution tax, any kind of tax is covered under the standard. All tax accounting is pretty simple and straightforward. Only thing which will slightly trouble us is computation and measurement of deferred taxes. The deferred taxes related portion alone we should be careful. Now, in CA Inter, you might have studied AS 22 taxes on income, which also deals with the same aspect. Now, in IND AS 12, the same thing we are calling it as income taxes. Now, for computing or identifying deferred tax asset or a deferred tax liability, in AS 22, we used to adopt something called as income approach. That's how the standard has been coded, by following something called as income approach. Income approach ka broad meaning is this. Let it be any item of income or expense. In our accounting P&L, you booked so many incomes, you have recognized so many expenses. Here you will have profit before tax first. Now, on this profit before tax, whatever you are getting in P&L account, this is not the profit on which you go and pay tax. For payment of tax, you have to compute taxable income in accordance with the Income Tax Act. Now, if you remember your PGBP chapter, how you used to do, you used to take profit before tax as given in the accounting P&L account. So that you used to make adjustments. There are some expenditures which you booked in your P&L account, but those expenditures are not acceptable. So we'll say that expenditures are disallowed. Some expenses are disallowed forever. Some expenses are disallowed. Some expenses are allowed with a different amount. For example, depreciation is there. Whatever depreciation you booked, that income tax fellow will not like. So our depreciation places, they will give you depreciation computation some other manner. So some other expense calculation it may be allowed. Then there may be some incomes which are exempt from taxation, that they will remove. Finally, you will arrive at taxable income. This is the amount on which you apply tax and identify how much tax you have to pay. That normal provision for tax amount, whatever you compute when you apply your tax rate on this taxable income, that is called as current tax. Current tax for all purposes basically means according to the income tax laws, how much amount you have to pay as tax in a particular financial year, that is referred as current tax. Obviously, there will be a gap between the profit before tax and the taxable income. Now, how in AS 22 was talking earlier is accounting income, that is your PBT, versus taxable income. The difference is identified into two reasons. One is temporary difference. Actually, the language is timing difference, but anyway, it's okay. Temporary difference and permanent difference. Temporary difference means today accounting income and taxable income both are not same, but whatever is the reason for the difference, that reason is going to reverse at a later date. So for example, you say my total income is higher in the current year because a bonus is disallowed, because bonus is not paid. Because of that, my total income, my taxable income is higher than accounting income. Even though your taxable income of current year is higher, subsequent year when you actually pay the bonus, at the time income tax fellow is going to give you a deduction of that bonus. That means even though taxable income is higher than accounting income in the current year, in the next year taxable income will be lower than accounting income, because when bonus is paid, deduction is allowed. Are you understanding, sir? This is called as a temporary difference. Same goes with the depreciation. I am charging 10% SLM basis. That fellow is giving income tax act rates, so they are allowing his depreciation. So my depreciation is 10,000. According to income tax act, I am getting a depreciation of 15,000. I am getting more depreciation there. because of the depreciation difference, accounting income and taxable income will be different. If you observe, even though year on year depreciation amount will be different, if you take the entire life of the asset as 10 years, in entire 10 years, the total depreciation what I charge in my P&L account, whatever depreciation I get as a deduction under Income Tax Act, both will be same, because overall only the cost of the asset will be allowed as a depreciation. That means even though year on year differences may be there, overall life of the asset difference will not be there. That means what? The accounting income and taxable income, whatever differences are there, those differences are going to be reversed. These kind of reversible differences are called as timing differences or temporary differences. There are some differences which are never going to reverse. These are called as permanent differences. For example, you have agricultural income. Agricultural income, you will obviously offer it in your P&L account as income, but that is exempt from tax. So income tax fellows say, sir, remove this, we are not going to tax on this. Oh, current year you did not tax, next year they will tax again. No, the permanent difference. Are you understanding? Similarly, you made a donation to a private trust where your wife and kids are members. That you booked it as expense in your P&L account. Expense, there is no doubt. But income tax point of view, disallowed. Disallowed, no, allowed next year. No, permanently disallowed. Similarly, weighted deductions. I contributed to some IIT for scientific research. I contributed 1 lakh. But Income Tax Act gives me 1,50,000 deduction. I extra 50,000 deduction, whatever I got, a pure benefit for me. I paid lower tax in the current year. That does not mean that in future they will disallow again and I have to pay higher tax. No, permanent differences. So, if something is identified as temporary differences, on this you have to create a DTA or DTL. Then what you have to create, we'll see. If it is permanent differences, no DTA, no DTL, you simply have to ignore this. Now, sir, should I create a DTL? Let's see. Suppose, in a particular year, your taxable income is higher than accounting income. In your mind, you keep one example always as a hook point. Bonus is disallowed. I declared bonus to my employees, but I did not pay. Income Tax Act says before filing of income tax return, if you don't make certain payments, deduction will not be given to you. In that, bonus, interest, some kind of employer related contributions and all are included in that. Okay, so if bonus is disallowed, because of that my taxable income is higher than my accounting income. Because of that I pay more tax or less tax? I pay more tax. In that current year I pay more tax, but in future when I actually settle the bonus, I will get a deduction under Income Tax Act. That means in future I am going to pay lesser tax. That means higher tax now, lower tax on a later date. That means in future one benefit is waiting for me because I paid higher tax now. Therefore, you have to go and create a DA. Because future benefit is there. What benefit? In future I will pay lower taxes. Therefore, today you should have an asset in your balance sheet. So the entry for this will be DTA account debit to P&L account. I am talking AS22, sir. We did not even open the scene of Ind AS 12. Ind AS 12 will come, don't worry. Next. Subsequently, in the next year, I actually paid bonus. Since I actually paid bonus, my taxable income is lower than accounting income, because of which I paid lesser tax. That means in the next year, my taxable income is lower than my accounting income. That means I paid lower tax, because once upon a time I paid higher tax. When I paid higher tax, I created a DTA. Now that you enjoyed the benefit by paying lesser tax, a dummy entry, whatever you created, DTA, that has to be reversed. So in this case, what you will do is reversal of entry will be reverse entry, P&L account debit to. So this DTA is a kind of a dummy account, sir. Temporarily we create, subsequently when we pay lesser tax, immediately DTA has to be reversed. Second scenario, my total income, sir, my taxable income is less than accounting income. Imagine, because of excess depreciation allowed. I have an asset whose life is 2 years. SLM I am claiming depreciation. That means in my accounting books, depreciation will be booked over a period of 2 years. Income tax fellow allowed 100% depreciation the first year itself. If more depreciation is allowed, my taxable income will be lower and the amount of tax what I paid also will be lower. But am I happy forever? Why? Even though I am paying less tax in the current year, I know that next year the depreciation whatever I claim in my P&L account will be disallowed and Income Tax Act will not give us any more depreciation. That means in future I am going to pay higher tax. That means lower tax now, higher tax on a future date. So this is a case of you creating a DTL. Why DTL? In future you have to pay tax. That's it. So the entry for this will be P&L account debit to DTL. Let us say we are in the next year now. In the next year, in my accounting P&L I claim a depreciation. While computing taxable income tax adds back the depreciation and he will not allow any further deduction because already he gave deduction in the first year. Because of that I paid higher tax. In the second year my tax naturally will be higher. Since I paid higher tax, my liability whatever I created here, a liability you have to reverse. So first entry will be DTL account. Because you paid higher tax, your total income is higher, so taxable income is higher than your account. Now, in this you have to observe something. Generally, whenever I say you paid higher tax now, people come with the answer that if I pay higher tax, create DTA. That is not wrong, but that is incomplete answer. If you are paying higher tax, look at this. This is one case where you are paying higher tax. Answer is what? Create DTA. Look at this. This is also a case where you are paying higher tax, but here answer is not creation of DTA, but it is a reversal of DTL. So how you have to think is, when you pay higher tax in a particular year, what is it a consequence or is it a origination? If you pay higher tax now, but in future you are going to pay lower tax, then create a DTA. What is the other possibility? I am paying higher tax now because once upon a time I already paid lower tax. So if that is the case, when you paid lower tax, you would have created a DTL. A DTL you have to reverse. So you have to check whether the taxable income and accounting income, the difference whatever is there, that is a originating difference or reversing difference. Originating difference flow, it will be only creations. Reversing difference flow, you have to reverse what you have already created. Similarly, here also this originating is reversing difference. This is the entire story of AS22 broadly summarized. This story is also given in the concept book towards the end I have given. Okay. This, why we have to once recap all this is, in Ind AS 12, the methodology adopted for computing DTA DTL is not income approach, it is balance sheet approach. That is not difficult, but balance sheet approach is not this simple as income approach. So some people often tend to get confused while applying balance sheet approach. So if you have clarity on income approach, what will happen is, when you look at a case, you prima facie will know the answer. Amount you will know, DTA, DTL, clarity will come. Ind AS 12 also you will understand, but worst case, in case you get confused also, you will have answer in your hand so that you can adjust and present the answer as per Ind AS 12. So AS 22 is a kind of a cheat code for your Ind AS 12 questions. When you see any question, AS 22 answer 100% correct answer will come. You cannot write that, you will not get marks. You have to write answer only as per Ind AS 12. But in case if that is confusing for you, so prima facie in your hand answer will be there. So for that purpose we are doing this. So this is done. Now coming to Ind AS 12 officially. In Ind AS 12, for computing deferred taxes, standard adopts something called as balance sheet approach. Balance sheet approach, what will happen is, for example, I am having so many assets and so many liabilities. Against each asset, some amount will be appearing in my books. It is called as carrying amount. Similarly, against each liability, I will have some carrying amount. Whatever standard says is, whether it is asset or liability, procedure is same. Take the carrying amount of each asset and liability. Compare this with something called as tax base. Carrying amount is as per books of accounts. Tax base, something. With that you have to compare this carrying amount. On this difference you have to go and apply the tax rate. The resulting answer will be either a DTA or it will be, broadly this is the answer. So DTA DTL formula is carrying amount, compare it with the tax base, gap will come, on that gap you apply tax rate, answer should be identified either as a DTA or DTL. Now in this entire thing, time being, we can understand only two things easily. What is that? One. And two things are missing. What is that? What is tax base? Even if you understand tax base also, a difference should I ultimately identify it as DTA or DTL. These two things are pending, sir. Now, tax base ka meaning is, this is actually speaking, this is carrying amount of asset or liability for tax purposes. For already carrying amount you wrote, whatever carrying amount I have written, that is carrying amount as per our accounting books. Income tax point of view, separate books we will maintain. In that separate books, key asset, key liability, key what amount is existing, that is called as tax base. Now, thinking accounting from income tax point of view is not always easy. It will be slightly confusing also sometimes. That is the reason for computing tax base quickly, our standard has given certain formulas. So, tax base question, the standard has given you some formulas. So, you apply that formula, tax base will directly come. But whatever I wrote on the screen here, this is called as core principle. Sometimes a formula also will not work, but this will always work. This is called as core principle of determining tax base. Tax base means if I start doing accounting, not as per accounting standards, not as per IND, but as per Income Tax Act provisions, whatever is the carrying amount of asset or liability, that is called as tax base. But officially tax base ke formulas are there. Okay, but this is also equally important. So let us understand now formula for tax base, and this dabba ke end result, should I call it as a DTA or should I call it as a DTL? Now how to see that is, first let's start with assets. Sir, do you agree that asset and a word itself means future economic benefits? Asset is nothing but a resource which is capable of giving us future economic benefits, and if that asset is appearing in my balance sheet, that means what? Asset definitely would have passed recognition criteria. Recognition criteria, so many standards we studied. Everywhere what did we say? It is probable that future economic benefits will flow to the entity, correct? That means asset itself, the word asset itself means future economic benefit will come to the entity. Remember that. Now, for assets, we have to understand how to compute tax base. If future economic benefits are taxable, whatever benefits are there, if they are taxable, then tax base is equal to future deductions in tax laws, if any. Any deductions you are going to get in future, our deductions must be identified as tax base. If future economic benefits are not taxable, then tax base should be equal to carrying amount. This is a formula for tax base, but I am telling you, sir, if you don't like the formula, skip it. You can happily write tax base with the help of core principle also. Only thing is, some cases that will be really confusing to think. That's why formulas are given. You need not by heart anything, but if you by heart also, there is nothing wrong. Logic will come slowly. This is about tax base. Now, DTA na DTL, how will I know? DTA oblique DTL is equal to carrying amount minus tax base into tax rate. Now, The difference whatever is there here, the box alone I am talking. You have to see whether this box is positive or negative. If it is positive, a box is referred as taxable temporary difference, TTD. If it is negative, it is called as deductible temporary difference, TTD. And if it is a taxable temporary difference, the final answer what you get is a deferred tax liability in your. If it is deductible temporary difference, that means if that box is negative, final answer will be DTA in your. So this is the overall structure of assets. Let it be any asset, this is what you are going to apply. Now coming to logic quickly. Observe, sir. Tax based law, how many models are there? FEB is taxable, FEB is not taxable. Once go and think about the second one. If future economic benefits are not taxable, then tax base is equal to carrying amount. Now apply that in this formula now. If tax base is also equal to carrying amount, then this box will burn to 0. If the box becomes 0, answer also will be 0. No DTA, no DTL. So if at all you have to get a DTA or DTL, it should definitely be first case. Future economic benefit should be taxable. Now I'll write something, see whether you can understand this. Carrying amount means, can I now confidently write that is taxable future economic benefits? Because if it is not taxable anyway, that box is going to become 0. Correct now? So it should be future. Carrying amount means future economic benefit is taxable also. What is tax base ka definition we wrote first case? First case. Tax base is equal to future deductions. Meaning, I will get some future economic benefits which are taxable. This is income. This is deductions. Income minus deductions. If the number is positive, what does it mean? Who is higher than who? Income is higher than deduction. So on a net basis, you will have income only. In future, you are going to pay tax. Therefore, today you should create a DTL. If this dabba is negative, what does it imply? When will it be negative? If deductions in future are higher than income, more deductions are there in future. That means in future I will pay tax, I will pay less tax. I will pay less tax in future. So today you should have a DTL. That's all is a logic. Are you all clear with this? Sir, DTA detail, different people use different kind of presentations. Some people will say TV minus CA. Okay. I am telling this because it's very logical to understand. I am not trying to be different or something. Study material approved only, so don't worry. I am properly going as per India AS 12, and this is logical. If something else is more logical, I would have followed that, but this is logical. I need not by heart anything. Absolutely straightforward. I will show you some examples, see whether you can identify something out of that. So we are done only with assets. Then liabilities again we have to do. Okay, tell me this, sir. Sir, all the questions in your study mat, RTP, everything can be solved with this story only. Focus on the example. Sir, in the balance sheet of A Limited, there is a plant and machinery of 70,000. Then he tells you that the original cost of the plant is 1 lakh. But why is it appearing at 70,000 today? Already depreciation. For tax purposes, depreciation allowed is only 20,000. But in our books of accounts, I claimed how much? 30,000. Tax rate is 30%. DTA or DTL he is asking. First and foremost thing, you have to identify the tax. Sir, if you use plant and machinery, manufacture goods and sell them, taxable only. If you sell plant and machinery directly, then also there is taxable only. So future economic benefits are taxable. When future economic benefits are taxable, tax base is equal to future deductions under IT Act. In future, what deduction will I get? Out of 1 lakh cost 20,000 already I claimed. In future, how much deduction will I get? 80,000. This is tax base. Now coming to DTA oblique DTL. Carrying amount minus tax base. What is the carrying amount? 70,000 minus tax base 80,000. Tax rate question was given 30%. Observe closely. The dabba inside is negative. For an asset, if you have a negative number inside, is a DTA. This one you have to remember, sir. See, logic we may understand, all that is fine, but ultimately you have to remember. Logic will only help you to remember easily without confusion. That's all. But ultimately you have to remember. If you go on thinking every time all this, exam will consume lot of time. Only one case, no problem. Big questions will be stuck up. So it's better to remember the chart of when DTA, when DTL, minus, plus, and. Are you clearly here? This is plain version. Now, tax base, how did I write here? Future deductions are a point of view I wrote. Can I apply core principle also? Yes. Core principle means what? Carrying amount of this plant and machinery as per Income Tax Act. If you maintain books as per Income Tax Act, original cost is 1 lakh. How much depreciation did you claim? 20. 1 lakh minus 20, 80,000. As per core principle also, tax base will be 80,000 only. Nothing is going to change. Are you clear? Next. I have debtors 150,000. Tax rate is 30%. A Limited follows mercantile system of accounting. Mercantile system of accounting means accrual basis. Income Tax Act gives a choice to the entity to maintain either on cash basis or mercantile basis for two heads of income, BGBP and income from other sources. So, if debtor is appearing in my balance sheet, it means that in accounting I already recognized the revenue, and income tax point of view also you already offered that revenue as income. Sir, how do you know, sir? Go telling you. Okay. Now, the debtor benefit, how will you get? Debtor will come and hug you. He'll pay you cash. When we realize that money, our money is taxable or not taxable? Collection from debtor, taxable or not taxable? Not taxable. Why? Revenue already offered at the time of sale. So collection is not taxable. Since collection is not taxable, future economic benefits are not taxable. In that case, tax base will be equal to carrying amount. So CA minus TB will become 0. No DTA, no DTA. Next, look at this example. Stock I am having 1 lakh. Tax rate is 30%. DTA or DTL. Stock ka benefit, how will I get? Finished goods, how will I get? I will use it. I will sell it. When I sell the stock, is it taxable or not? Yes. So future economic benefits are taxable. When future economic benefits are taxable, what is tax base formula? Future deductions under Income Tax Act. Now, listen carefully. Stock tomorrow I sell in the market for 1,40,000 rupees. Tell me, sir, I have to pay tax on how much amount? You pay tax on sale revenue or profit? Profit. Sale revenue is 1,40,000. But I am paying tax only on 40,000. Means how much deduction Income Tax Bill is giving me? Cost of goods sold 1 lakh. The future deductions under Income Tax Act is 1 lakh, which is the cost of the stock itself. So tax base will be equal to 1 lakh. So when you do CA minus TB, it is also becoming. Sir, second case where future economic benefits are not taxable, అది పక్కా zero అవుతుంది sir. But first case also sometimes zero can happen like this. Sir, if DTA or DTL should come, the carrying amount as per books of accounts, and carrying amount as per Income Tax Act, both should be different. Then only DTA will come. Otherwise, where will it come? If I am also saying that cost of stock is 1 lakh, he is also accepting that yes, it is 1 lakh only. Where is difference? Why DTA, DTL will come, will not come? Same story, slight change I made. Stock appearing at 90,000 carrying amount. Cost of stock to ABC Limited was 1 lakh actually. But it has return of 10,000 rupees as expense with respect to obsolete stock. Some outdated stock is there, they removed it from the balance sheet. So effectively 90,000 only book is appearing, 10,000 loss we booked in my accounting P&L. But no such expense is allowed as per tax purposes. That means what? As per Income Tax Act, the carrying amount of the stock is how much? 1 lakh. But as per books of accounts, 90,000. So our carrying amount is 90,000. Income tax point of view carrying amount is 1 lakh. Income tax point of view carrying amount called as what? Tax base. So tax base is how much in this case? 1 lakh. No sir, I will apply formula. Apply. Tomorrow is stock, you sell it for 1,50,000. Tax you have to pay on how much? 3,000. Because income tax fellow will give you deduction of 1 lakh rupees. Future deductions under Income Tax Act is called as tax base. Or think apply core principle, that also will be 1 lakh only. Am I clear here? You got your tax base. Now, DTA minus DTL. Carrying amount 90,000 minus tax base 1 lakh. Inside brackets you are having negative number, therefore answer will be a DTA. Clear? Now, this is income approach. AS22 point of view also you can think. You booked some valuation loss in P&L account debit side. Income tax fellow says, I will not allow this. Disallow. Fine, disallow. If you disallow, what will happen? I will pay higher tax. But in future, I will pay lower tax. Definitely creation of DTA. Income approach will work everywhere. Only thing is the answer you cannot write. Just for internal feeling, you will think like that. The answer you have to write. Clear? Answer this, last one. You have investment in equity shares, 1,80,000, measured at FETPL. Which standard? Forgot. This 109. The original cost of investment is 1 lakh. Once upon a time I purchased it for 1 lakh, but in my balance sheet it is appearing at 1,80,000 because FETPL. Tax rate is 30%, DTA. Tell me, sir, if I sell this investment, is the future economic benefit taxable or not? Future economic benefits are definitely taxable. Therefore, tax base will be equal to future deductions under Income Tax Act. Tell me, sir, right now, spotly, if I sell off this investment, I get 1,80,000. Right? How much tax I have to pay? On which amount I have to pay tax? 1,80,000, yeah? 80, yeah? 80 only. Why? Cost will be given as deduction. So, future deductions under Income Tax Act is how much? 1 lakh. That 1 lakh will become your tax. Clear, sir? Now, core principle point of view also you can think. See, I purchased it for 1 lakh. I wrote investment to bank 1 lakh, 1 lakh. But our India is 109 is crazy, no? They are asking you to do FETPL. So, at the end of the balance sheet date, you went and wrote investment account debit to PRL, gain 80,000 also. Therefore, it became 1,80,000. That kind of entry will you write under Income Tax Act? Huh? Will income tax fellow charge your fair value gains? Huh? No. So, according to that fellow books, investment is still appearing at 1 lakh only. So, tax base is 1 lakh. Core principle also will apply everywhere. Sometimes it is difficult to think, this is easy to execute. That's why formulas are given. Am I clear here, sir? So, CA minus TB into tax rate when you apply. If the answer is positive ultimately, it indirectly means that future I have net income. On that I have to pay tax. Therefore, today you should have a DTL in your balance sheet. If the answer is negative, future I will have deductions. Future I will pay less tax. Today you should have a DTA in our balance sheet. Clear, sir? So, this is the story with your asset related side. Now, coming to liability related story. Relating to liabilities, again same thing, you have to identify what is your tax base. Now, tax base for liabilities, if it is a loan case, tax base you will take it as face value of loan. Sir, what is this formula? This formula actually, if you see, study mat also they won't give you this formula. This formula, correct one is not wrong, but it's not given as a formula. I am making it as a formula. Because after 109 you must understand. I raised the money of 100 lakhs from the bank. The process I paid processing charges also 1.5 lakhs. Your ACM technique says that initial recognition of liability should be done at 98.5 lakhs. And whatever 10% coupon you are paying to the bank every year, that is not your interest rate. In fact, 11.05%, which is your effective interest rate, must be used for measuring interest expense, isn't it? That is how you arrive your carrying amount. ACM table you will play every year ending, some carrying amount will keep on coming. Tell me, sir, does income tax fellow know all these points, sir? Will he adjust processing fees into original carrying amount of the loan? No. According to income tax point of view, what will he say? How much loan did you take, sir? 100 lakhs. That's all, your loan is 100 lakhs. Sir, I paid processing fees. You paid? No. Take it as expense. Don't adjust it to loan account and all. Income tax point of view, whatever face value is there, that only is their carrying amount. Therefore, that only will become our tax base for Ind AS 12 purposes. There. If you have any advance income ki example is, customer paid me money, goods I am going to deliver in future. As on today, did not deliver it yet. Since I did not deliver it yet, definitely it is a liability. Entry, what entry will you write? Bank account debit to advance for sales. So, my balance sheet liability, sir, I will show a advance liability. In future, when sale happens, I will kill the advance account and convert that into sales revenue. So a liability. If that kind of liability is there, then tax base formula is carrying amount minus advance income not taxable in future. Sir, what is all this, sir? What is advance income not taxable in future? Why is it not taxable in future and all? Listen, sir. Accounting point of view, the advance income is not income first of all, because sale did not happen. Ideally, income tax point of view also it should not be income. But in Income Tax Act, since it gives you cash basis option, the moment you receive money, you have a choice of offering it as income. In case you do that, under Income Tax Act, the moment you received money, it is already taxed. Then when sale happens, again they will tax. No. So in that case, advance income not taxable in future, an amount will come. No, sir, income tax point of view also, I am following accrual basis only. Whenever sale happens, then only I will offer income. Fine, in that case, this is zero. Because nothing is taxed, future totally will be taxed. It is like that. This is the advance income story. Now coming to any other case. In the general case, sir, this is what you have to properly remember. Any other case, tax base is equal to carrying amount of the liability minus future deductions per tax law. This is a general case. Actually, you have to remember the last one. First two are a kind of special case. First two are kind of special cases. Last one is what you have to remember. That is a tax based form. It all looks little bigger compared to asset formulas of tax base, but in fact this is not. This is in fact more easy actually. You'll understand this tax base. Now coming to whether the answer should be a DTA oblique. What is the general formula? CA minus tax base into tax rate. So the rule is if this number is positive, we will call it as deductible temporary differences. If it is negative, we call it as taxable temporary difference. If it is positive, then it should lead to a DTA in balance sheet. If it is negative, it will lead to a DTL in balance sheet. Sir, here what is the logic? Logic is simple. Look at this perfectly, sir. E box alone, I am just simplifying here. I hope you will understand correctly. Box plus CA is there, I wrote as it is. TB, tax base ki general formula is what? Carrying amount minus future deduction. Correct, no? So when I open this bracket, what will happen? CA minus CA, future CA will die. A dabba, whatever you are having, this box. The box basically represents future deductions under Income Tax Act. Means if the dabba is positive, it means that in future you will have deduction. If the dabba is negative, what does it mean? You will have opposite of deduction. What is opposite of deduction? Income. So future you will pay tax. Therefore you should have a DTL. If it is positive, future deduction only will come. You should have a DTA to pay. Are you understand, sir? That's how the formulas are framed. Sir, I did not like formula for tax base, and don't do. Apply core principle. Answer will come. 100% answer will come. You understand, sir? So this is all. Whatever I'm writing, it's all given here. One or two corrections were there because of the first edition book. No, the 8.3 page once check mark. Lastly, it should be printed as DTL. Updated or not updated? Please change it, no? 8.3 page, lastly it should be appearing it as DTL. Here, and that's it, sir, I think. All this is over. Now, similarly, few examples we'll see on liabilities also. That will give us a little bit more comfort. Tell me, sir. You have creditor, book value 50,000, carrying amount, tax rate is 30%, DTA detail is how much? Your thinking should be in two steps. Step number one, what is the tax base of creditor? Tell me, sir, tax base formula is what? Liability, carrying amount minus future deduction. If you pay money to creditor, will you get any deduction? Means what now? Tax base is equal to carrying amount, which is 50,000 minus no deduction, no 0. 50,000 minus 0, 50,000. So tax base is 3,000. So DTA detail will be 0 ultimately. Sir, if future deduction is there, you will write. If future deduction is not there, why will you write anything? It will be 0. Look at this case, you will better understand. You have bonus payable, outstanding bonus payment. Come 1 lakh rupees. Tell me, sir, bonus when you actually pay, will you get any deduction? Income tax act? Yes. So now apply tax base formula. Carrying amount minus future deductions. Carrying amount is 1 lakh. If I pay that 1 lakh, I will also get a deduction of 1 lakh. 1 lakh minus 1 lakh, 0. So tax base is 0. So DTA detail formula, when you substitute, our brackets is becoming positive. So you will have a DTA. In the income approach, how simply we discussed? I did not pay bonus. Income tax fellow disallowed. Therefore, I paid higher tax. But in future, he will allow, I will pay lower tax. You should have a DTA. Income approach is very easy to think. But this is the answer you have to write. Thinking you may think like that, but this is the answer what you have to write ultimately. Advance for sales also similar formula, simply you have to apply. Okay, there is a small case. Watch this. XYZ Limited incurred 1 lakh rupees preliminary expenses and recognized entire preliminary expenses as expense in PRL. You are not supposed to capitalize preliminary expenses and all. However, for tax purposes, as you all know, deduction is allowed over a period of 5 years. So every year 20,000, 20,000, 20,000, like that 5 years. Compute DTA detail at the end of first year, imagining tax rate is equal to 30%. First of all, tell me, which formula will you apply? This is neither an asset nor a liability. Preliminary expenses. It will not appear in my balance sheet also. Sir, then how will I get the answer, sir? First of all, just for internal comfort purposes, income appropriation, sir. How much expense did I book? 1 lakh. But he allowed only first year 20,000. How much is disallowed? 80,000 disallowed. So how much extra tax did I pay? 80,000 into 30%, 24,000 extra tax I paid. But in future he is going to allow this, no? So 24,000 rupees I have to go and create a DTA. Answer is that. Answer is create a DTA to the extent of 24,000. Fine. But balance sheet approach, how will I present my answer? See, if you come across items like this, what our standard says is balance sheet approach will not work always. I'm not joking. Officially standard it is there. Balance sheet approach will not work always. In that case, you can understand the impact of this item on your tax paid and create a DTA detail accordingly. Brackets indirectly apply income approach and a license he is given. Income approach you can apply when you cannot apply balance sheet approach. Indirectly, that's a hint. No, sir, I love balance sheet approach only. I want to do balance sheet. Do. Sir, which formula? Tell me. Preliminary expenses is not an asset, I agree. But preliminary expenses ke entry when you wrote first time, that is debit account or credit account. Preliminary expenses account debit to bank. So preliminary expenses basically debit account, no? Go and apply asset rules. Go and apply asset rule. If you apply asset rule, it will fantastically work. What is the carrying amount of preliminary expenses in my balance sheet now? 0, because I booked off entire thing into P&L account. What is tax base formula? Future deductions under Income Tax Act. Future how much deduction is 80,000. So DTA detail is equal to CA minus TB into 30%. CA is 0, TB is 80,000 into 30%. Brackets negative for an asset. Definitely DTA. If it is not working, you can make it work. Only thing is that's not an asset, but it's a debit item. You can still apply the asset related rule. Answer will still come. Are we clear here? It's a very interesting case. Look at this. You have debtor 1000, provision for doubtful debts 50, net debtor Carrying amount is 950. Tax rate is 30%. DTA detail is how much? As you all know, provision for bad debts is not a allowable expenditure. It is not a deductible expenditure. Pakka disallowed, sir. If that is allowed, no, everybody will create bad debt provision. So, not allowed. So, the income approach, how much is disallowed? No? 50. 50 is disallowed. 50 is disallowed, I pay higher tax. How much higher tax did I pay? 15 to 30%. 1, 5, 15. But in future, when it becomes actual bad debt, at that time deduction will come. Yes. That means even though I pay higher tax now, in future I am going to pay lower tax. Answer is what? DTA with an amount of 15 rupees. This balance sheet approach, how will I write? Think like this. What is the carrying amount of debtor? 950. Now I want tax base for this. How you should think is, apply core principle. Formula will fail you here. That's why case I am showing you. Formula will fail you here. Core principle apply. What is the core principle for tax base? If I prepare books of accounts in accordance with Income Tax Act provisions, then our balance sheet debtor is appearing at what amount? What amount? 1000. Income Tax Act point of view, bad debts will not be recorded unless you actually suffer it. Estimated bad debts is not recognized. Therefore, balance sheet as per Income Tax Act, debtor is appearing at what value? 1000. So tax base is clear, sir? Core principle to apply. No, sir. I will apply formula. Apply. Amount received from debtors is not taxable. Since amount received from debtors is not taxable, tax base should be equal to carrying amount. What is carrying amount? 950. 950 minus 950? 0. No detail, no detail. Correct answer? Wrong answer. Formula fail out, sir. Core principle will lead you correct. No, sir. Formula alone I want correct answer. There is a way. For everything there is a way, sir. See what I did. Debtor, treat it as asset. Provision for doubtful debts, that's a credit balance. It's not liability, but still treat it as liability. Apply liability rules. Answer will still come. 100% answer will come. Debtor 1000. That is my carrying amount now. Tax base is also carrying amount because it's not taxable. Asset said DTA detail 0. Coming to provision for doubtful debts. Since it's a credit account, apply liability. What's the carrying amount? 50. Tax base formula, carrying amount minus future deductions under Income Tax Act. If I actually suffer bad debt, will I get deduction? Yes. So tax base will be equal to how much? Carrying amount 50 minus future deduction 50. Tax base will be 0. CA minus TB 50 minus 0 into 30%. DTA. Any which way you can get it, sir. It's just that you should spend some quality time and do questions individually, peaceful. If you see and tick and all, no, sir, you will never get comfort. You have to apply mind. Try different ways. First income approach, answer you work out and keep it. Inside peace will be there. Then arranging only no number. Somehow you have to bring that number. Why will you get confused? You will never get confused. You play with it without pressure, then it will yield and surrender to you. Pressure, if you try to learn something, it will not come. You can't hurry up everywhere. So this is. Am I clear till now, sir? Okay. Now, there's something else which I have to do. Okay, fine. So, I have a machinery which I purchased it for 1 lakh rupees. Every year, I am charging a depreciation of 10,000. Like that, 3 years is over. The current year, okay, 10,000. Current year ending, my carrying amount is 70,000. For a tax purposes, also starting amount is 1 lakh only, but under Income Tax Act, they are giving me 20,000 depreciation per annum. For income tax, so straight line method is not there. So example, anything can be there. There are two particular, imagine there's a power generating company. Power generating SLM is allowed. So this is tax purpose point of view, this is a carrying amount. So this carrying amount only will become our tax base. They are having clarity up to here. Now, if I ask you to compute DTA or DTL, 70,000 carrying amount, 40,000 tax base into 30%. So inside I am having a positive 30,000 to 30%. What is the answer? That I know. DTA detail you tell me. DTA L. L is a DT. So my question is, what is the entry you will write? P&L account debit to with what amount? Wrong answer. Whatever answer you get here under balance sheet approach, this is also the DTL that should appear in your balance sheet, not P&L. Sir, P&L what entry, sir? Come to last year. By the end of last year, what was your carrying amount? 80,000. By the end of last year, income tax point of view, what was your tax base? So by last year ending only, in your balance sheet, DTL is already there to the extent of 6,000. In third year ending, it should be 9,000. So you have to further create a DTL of only additional 3. An important observation, balance sheet approach when you apply, whatever answer you get out of the formula, answer is not P&L ka impact, adi balance sheet lo desired number. Ade meer income approach cheste, you will not get balance sheet answer, you will get P&L answer. Look at this. I booked a depreciation of 10,000, but he allowed a depreciation of 20,000. He paid extra, he gave us extra depreciation of 10,000. Because of that, I paid lower tax. How much lower tax? 10,000 into 30%, 3,000. In future, I have to pay higher tax. So 3,000 ki detail you have to create now. Income approach answer will be P&L ka impact. Balance sheet approach ka answer is balance sheet la desired number. P&L impact you have to compare with the existing detail balance and work out. The observation important, sir, because MCQs the questions and all, you should not be confused, because since I told you income approach, so you can approach on sideways. You should understand also that income approach is only P&L ka impact, whereas the balance sheet answer is balance sheet la how much should be there, DTA are different. Sir, with this we are done with the basic story of DTA DTL, how to create, how much to create, DTA na DTL la tax base, how much and all. Fine. Now issues are there. First thing, come to 8.4. 8.4. In 8.4 there is something called as prudence limits for DTA. In that C pointer, it's printed as unlisted, please make it unutilized. In some books it is corrected, in some books it is not corrected, it's printed as unlisted, make it unutilized. First editions are some mistakes, printing errors only are there, concept no mistakes, don't worry. Some books I have corrected it, some books we have to update. C point, instead of unlisted it should be unutilized. Right? Now anyway, what is the meaning of prudence limit? It is actually very easy question, but slightly confusing also. Understand the story correctly. Sir, in the current year, I am having a bonus which is unpaid of an amount of 3 lakh rupees. Since it is unpaid, income tax fellow what he did is, he 3 lakh rupees he has disallowed. Since he has disallowed, I definitely paid higher tax. In future, I will pay lower tax. So disallowed, therefore we pay higher tax. But in future, if I actually pay the bonus, I will get a deduction also, I will pay lower tax also. So today I should create what? DTA na DTL la? DTA. So what is the DTA? You will create 3 lakhs. Imagining 30% tax rate, lakhs into 30%. So I should go and write an entry called as DTA to P&L with an amount of . Now, the standard says that anticipating a future benefit. Today you are recognizing a asset by crediting your income statement. Is it not slightly against your prudence concept? I paid higher tax, sure. But in future, you are saying that you will enjoy some tax benefit, and looking at that future tax benefit, you want to record some income in the P&L account current year by creating a DTA. Standard says that slightly you are beating prudence concept. I don't have a problem when you write this one. I don't have a problem here. You are debiting P&L, but whereas here you are crediting P&L, anticipating a future benefit. If I go and tell this to the client, customer, what he says is, no sir, how can I not pay bonus? If I don't pay bonus, legal consequences will be there. My employees will file case on me. Compulsorily I have to pay. Don't worry sir, I will definitely pay. Trust me. Please trust that I will pay bonus. Let me create DTA. India 12 says, I am not worried about your payment of bonus. Even if you pay bonus also, a bonus has to be claimed as a deduction from some income. I am worried about you earning that income. I am not worried about you not paying bonus. You will definitely pay. If you don't pay, what will happen? People will file case on you, or people will leave working from you. So for your own good, you will anyway pay bonus. If you don't pay interest to bank, will the bank keep it? Bank will seize your assets. You will anyway pay. I am not worried about that. I am worried about you earning income in future against which a deduction will be claimed. Are you getting it? So the standard is worried about your ability to earn future taxable income. So the standard asks you, when you are expecting to claim this 3 lakh rupees deduction, what will you be having taxable income sufficiently to absorb this bonus deduction? Our doubt is here. My doubt is not about you not paying bonus. You will pay bonus for your own good. My worry is, if you pay bonus, you want to claim it as deduction, will you have sufficient future taxable profit? That is my worry. If you tell me that, no problem sir, look at my P&L account, last 3 years, last 5 years you see, never it was below 10 lakhs. My order book is full, next year also it will be in fact more than 10 lakhs. If it is probable like that, happily create DTA account debit to P&L. I don't have a problem. I don't have a problem. No sir, we are newly formed entity. Last 2 years loss, but loss is reducing, but now loss only. Next year also loss only will come, sir. Sir, next year even if you pay bonus also, but you are already a loss making company, can you enjoy the benefit of bonus? Bonus if you pay, they will give a deduction. Deduction if you have to claim, first of all you should have income. This fellow does not have income, not likely to have income in future. The standard says, when you are not likely to have income in future, you cannot claim this deduction. Since you cannot claim this deduction, tax saving will not come to you. Since tax saving will not come to you, don't create a DTA to the extent that income is not going to be there. But the standard asks you, are you having any reversals of taxable temporary differences which will create taxable income in future? Sir, what is all this, sir? Simple. Now I told you one case, which is bonus unpaid. I am telling you another example now. Excess depreciation allowed in year 1. Sir, the unpaid bonus should ideally create a what? DTA. Excess depreciation should create a DTL. Why will it create a DTL? I got lot of depreciation more than what I asked. Because of that I paid lower tax. In future, whenever I say depreciation income tax, I will say shut up. 100% I gave you in the first year itself. Are you understanding, sir? Right. Now, I ask this fellow, Arey, 3 lakh rupees bonus you did not pay. Therefore, I am dissolving now. When are you going to pay? This fellow says, sir, I will pay like this. 75,000, 75,000, 75,000, 75,000. I will pay it over a period of 4 years and I will claim deduction, sir. Very good. That is his plan. Then I ask you, where is taxable income? Where is income against which you will claim this deduction? He says income ille, sir. Loss making company, maximum trying to break even, that's our income not there. Don't create DTA, simple. No sir, I want to create DTA. Where is income? This fellow says, sir, you forgot. First year you gave me extra depreciation allowance. Because of that I paid lower tax. From next year onwards in my P&L, I will write depreciation. What will you do? You will disallow. Whenever you disallow, what will happen? A disallowance will create a taxable income. Even though you earn zero income, because of depreciation disallowance, taxable income is getting created. So income due to depreciation disallowance. Suppose I am having 1,20,000, 1,20,000 and 1,20,000, and here nothing. Asset life is only remaining 3 years. Now tell me, sir, is 75,000, can I claim this reduction? Yes, because I will have income. Is 75,000? Yes. Is 75,000? Yes. Is 75,000, okay, I do not have corresponding income against which I can claim this deduction. So, out of your 3 lakh rupees today, you have having estimated income to the extent of 2,25,000 against which this can be adjusted, and for 75,000 you are not having any income. So this into 30%, whatever answer you get on that, go and create a DTA. On this you will not create any, because you don't have parallel income for that. This is called as prudence limit of DTA. DTL I don't have a problem, DTA I have a problem. Either show proof that you are going to earn income, the probable future taxable income. If that is not there, at least to show me that some reversals are there, or reversals are capable of creating income against which I will claim the deduction. So this is also not there, sir. What is our situation? Then he will ask you, can you do any tax planning opportunities? Tax planning opportunities. Tax planning opportunity means apply some smart idea and create taxable income. Why will I create taxable income, sir? Unnecessarily have to pay tax? No. You create taxable income against which a deduction can be claimed. Ultimately, you will not pay tax. But just because you can claim this deduction in future, today you can create a DTA by which your profit of current year will increase. This is tax planning strategy. Simple examples generally here would be, if you are having an asset which is giving you some income, but that is an exempted income. For example, you are having some building, you are having some land which is used for agricultural purposes. Agricultural income you are earning every year because you are doing agricultural business only, but that income is not taxable, exempt. What to do? Sell that land, use that land, or buy another land which is giving you taxable income. Because of that, what will happen? This time I am going to do business on a commercial thing, land only, but some other purpose other than agriculture. So the income what I get from this is definitely taxable. Since I created taxable income, against the taxable income, deductions can be claimed. Since the deductions can be claimed in future, today I can create a DTA. So use some tax planning opportunities and create taxable. So these 3 points are either future economic benefit future taxable profit should be probable, or reversal of TTD should be there, or apply tax planning opportunities and create taxable income. And if you have any of these 3 only, you can create a DTA. Otherwise, forget about DTS. Yes, sir. By the way, if you are a company having accumulated carry forward losses or unabsorbed depreciation, this kind of companies can create DTA only if they show existence of future taxable profit with sufficient convincing evidence. Proof I want. Sir, you are loss making company, sir. Loss making company low, loss can be carried forward up to next 8 years and I can adjust it. When you adjust it, what? You will get tax savings. Sir, I want to create DTA now. I ask you, sir, what is the chance of you earning profit next year? Full chance, sir, I will earn profit. You will say like that only, but why will I believe you? You are already a loss making company. If you are that talented, no, you would have earned profit in the current year itself. So, standard says I will not believe you if you say that it is probable. I want evidence. Show me proof. Sir, already orders are getting booked. First quarter over, sir, by the time I am preparing my financial statements, first quarter already we earned profit. Some kind of proof if you show, then only DTA creation is permitted when the company is already suffering losses or it has unabsorbed depreciation. So guys, this is that for prudence limits. Now, tax rates. Tell me, sir, deferred taxes are current year impacts or future tax impacts? Deferred taxes are future tax consequences, correct? So, deferred taxes should be measured at tax rates which are applicable for future period, whereas current taxes should be measured at tax rates applicable for the current period. For example, you have a disallowance now. Future law, when you pay, it will be allowed. On the DTA you have to create. But in this current financial year only, before 31st March, Auntie presents budget. In that budget, she told that next year tax rate is 40%. But for current year, it was 30% only. So, current tax you will measure at 30, but deferred tax you have to measure at 40%. Because deferred taxes are future tax consequences. So, latest tax rates that are enacted or substantively enacted on or before the balance sheet date only you have to consider. You should not take latest tax rate that is finalized after the balance sheet before the date of approval. That is non-adjusting event. Don't touch that. There are questions on that. Do not touch that rate which is finalized after the balance sheet. It should be finalized or substantively enacted on the balance sheet. The substantively enacted means what, sir? Sir, you know how Income Tax Act bills are passed. Lower house approval should be required, upper house, then ultimately president sign, official gazette lo notice. This process anta there. But you know, current government is enjoying significant majority. So there is no chance that the bill will be stopped and all. Lower house is already approved. It's just a matter of time that it will get approved and ultimately get notified. But by 31st March, it did not get notified, but one of the houses have already approved it. It is called as substantively enacted. Am I clear here, sir? Any questions on this story? You should understand. Now, final part of the standard. This is special cases. Few special cases we will cover in different standard whenever we come across there, but predominantly we will finish off here only. Look at this mark correctly. There is a company A Limited. There is another company B Limited. Now, our A Limited absorbs B Limited. Business combination transaction. This fellow B Limited has got 3 assets. For simplicity, I am assuming only 3 assets and nothing else. So they have plant, they have a building, and they have, let us say, debtors. 3 assets they are having. These, they have a carrying amount of 3,000, 5,000, 2,000. Total carrying amount is 10,000. You all must have basic idea that in a business combination, whenever I absorb another entity, that another entity assets and liabilities should be recorded in our books at what value? Fair value. India is 103 fair value, so you have to incorporate, correct? No? So, fair values I am writing. So, if plant fair value is let us say 4,000. Building, 200. Building of fair value is 4,000. Stock of fair value is say 2,000 only. So total it is 1,200, 9,000. This is a fair value. Okay? Now, the PC what A Limited pays to B Limited is 11,000. Forget about taxes and all for a moment. Normally write the incorporation. Plant account debit 3,200. Building account debit. Stock account debit 2,000. 2. PC paid. I am directly writing bank 11,000. The entry pakka will not tally. Tell me the gap. 1,800 or 1,500. This will be identified as what? Goodwill. Now, the entry if you write like this, okay, the entry one small problem is there. What is the problem in this entry? Problem is you did not consider the tax consequences. Now, let's first understand what is Income Tax Act rule. Income tax fellow has got one rule that when one company absorbs another company, for this purchasing company point of view, all these are new assets for them, which are now newly acquired. But in reality, new assets are second-hand assets, already used assets. Somebody already claimed depreciations on that, correct? No? So, income tax fellow says that how am I looking to you? Do you think that I will believe all these are original cost again and start providing depreciation from the very beginning? No, what he says is, even used assets which are taking in the process of a business combination. A selling company, whatever tax bases are there, the same tax bases are considered even for the purchasing company also. I don't care in your books what amount you record, I don't care. According to me, it is used asset. Already somebody claimed a depreciation. A remaining depreciation only I will give it to you. So the tax basis of the selling company, acquiring entity, away tax basis as it is are used for acquirer also. This is not coming from our India's, this is the Income Tax Act rule. Clear here? Now for convenience and simplicity, I am assuming that this fellow has got the same tax base also. It can be different also, don't worry, just easy example continue. Now tell me sir, from A Limited point of view, do you agree that whatever is appearing as fair value, that only will become the carrying amount also? Why? Because he is going to incorporate everything at fair value, so the fair value only will become carrying amount. Whatever is given as carrying amount for the acquiring entity, in the absence of information, that only you have to accept it as tax base. So what is visible as CA in the question is not CA, that is tax base. What is visible as fair value in the question, that's not fair value, that is actually your carrying amount. Clear sir? Now let's start. Total carrying amount is 9,200. All our assets only direct writing. Tax base total is 10,000. So for assets, if I do CA minus TB, I am having a negative 800. Let us check 30% into 30%. So 240. This is a, for an asset, if I get a negative number, it is a DTA. DTA ka meaning is what? In future we will have to pay more tax or less tax, we have to pay less tax. In future, if I am paying less tax, do you agree that once upon a time I paid higher tax? Now tell me, once upon a time who paid higher tax? A or B or B? Once upon a time who paid higher tax? B paid higher tax. But in future who is going to pay lower tax? A is going to pay lower tax, correct? No? So when A is trying to take over B, B will say, Babu, along with these three assets, you take over me, you will get one extra advantage also. What is that? Future you will pay lesser tax, because once upon a time I paid higher tax. Correct? So B Limited knows this fact. So while collecting PC from A Limited, B Limited would have collected money for that also. So when you are A Limited now, it will be wrong on your part to record only these three assets and recognize goodwill. What you have to do is, before you write balancing figure, goodwill, you should also recognize DTA of 2. Because you paid money for that also. Or DTA or DTL, whatever comes, that also you have to recognize, and then only you will take a balancing figure. So it will be how much now? 15. Story. Clear? Entire story in one line, it is like this. Selling company ka tax bases are continued for purchasing company also. But purchasing company will record everything in their books at fair value, which will become their carrying amount. As a result, carrying amount ki tax base ki gap will come. On that gap, DTA detail will be there. That DTA detail has to be recorded in the incorporation entry only, and then only goodwill or bargain purchase gain should be determined, not before. Clear? Correct. How much goodwill did you get in this example? 1560. This accounting books lo goodwill. Income tax point of view, that fellow will not do this accounting, so he will not have goodwill and all. So tax base for this goodwill is 0. So goodwill carrying amount is 1560, tax base is 0. Now if I apply DTA DTL formula, CA minus TB into 30%. This is 468, 468 DT. Correct only computation and all. Now the standard says, don't create this. Don't create this. This is an exception for creation of DTA, DTL. Or why should I not create this? Create and see, you will automatically know. Create. If you create, what should I do? I should go and write DTL for. Do you think that entry will tally? What will happen? Again goodwill will increase. Again you will compute detail. Again detail will increase. Again goodwill will increase. A loop effect will come. That's why goodwill ka detail should not be. Important question. This is about business combination. Consolidation related unrealized profit is there, that we will talk when we do consolidation chapter. Now coming to revaluation point. This is also interesting point. Now sir, generally we are all under the normal opinion that when you create a DTA, the entry will be P&L account debit to, sorry, DTA to P&L. When you create a DTL, the entry will be P&L account debit to DTL. This is normal, that's there in our mind, because AS 22 is like that. But Ind AS 12 is not like that. What Ind AS 12 says is, if the income or the expense is recorded in PRL, then the tax accounting also should be done in PRL. If this income or expense is recorded in OCA, then tax accounting also should be done in that OCA. If income or expense is recorded directly in the retained earnings, reserves and surplus, then the tax relating to that income or expense should also be done in retained earnings. So if I ask you what is the entry for creation of DTL, generally we may say P&L to DTL for normal discussion purposes. When case to case comes, you have to see our related income is accounted where. If that related income is accounted in OCA section, you have to create DTL via OCA, not via P&L. Simple example for this is, look at this. Sir, I purchased an asset, building one sir. This is as per accounting, this is as per tax purposes. Okay, 1 lakh. They are also 1 lakh. For first day, both are friends only. Then I charge the depreciation. I booked 30,000 depreciation. That fellow gave 20,000 depreciation. Right came no. According to me, carrying amount is 70, but according to that fellow, it is 80. Is stage low, sir. If I ask you to compute CA minus DTA DTL oblique DTL equal to CA minus into 30%. First column is carrying amount, second column is tax base. 70,000 minus 80,000. How much is that? Minus 10,000 into 30%. 3,000. DTA na DTL la? 3,000. I am having a. Clear clarity is there? Now, this fellow did not keep quiet. He applied Ind AS 16 ka revaluation model and he fair valued the asset. And he fair valued this to 1,20,000. He updated this by 50,000. This fellow, poor fellow, he did not do anything. It's still 80,000. Tell me, what is the answer now? 1,20,000 minus 80, positive 40. 40 into 30%. 12,000. Ultimately, in your balance sheet, you should have only 12,000 DTA. The final answer. But you know what is the entry for this? When you got the DTA, a DTA, do you agree it's purely because of depreciation? And depreciation is accounted where? PRL. Therefore, DTA to PRL with an amount of 3,000. Then, again difference came, and this difference came because of revaluation surplus. Ind AS 16 we covered. Revaluation surplus is a OCI item. Since this 50,000 rupees gain is recorded in OCI, if 50,000 ka tax consequence also should be recorded in OCI only. This is a DTL case. The entry for this will be revaluation surplus in OCI. Revaluation surplus ke apne debit to DTL. 50,000 rupees into is equal to 15,000. In the balance sheet, you will have a DTA of 3,000 and DTL of 15,000. If you remember our schedule 3, DTA DTL brackets lo net ane word will be there. On a net presentation, a DTL will become You understand, sir? When you do simple formula CA minus TB into tax rate, with final answer vastund. Accounting is not so easy. You have to understand why the difference came and accordingly hit the PRL or OCA as the case may. Am I clear here? Are you understanding, sir? It's important stuff. Regarding this also. Okay. Listen, sir. We are now talking about ESOPs. You all understand what is the basic meaning of ESOPs and all. There will be one vesting period. Let us say 1, 2, 3 years vesting period is there. Accounting, what we will do is we will work out the fair value of the option on the grant date. Let us say it is 90. Whatever fair value of option is there, that only we will book it as option expense over the vesting period. So in 90, I will book it as expense over a period of 3 years, 30, 30, 30. Assume only one employee, one option, one share only. Fair value 90, I will book expense of 30, 30, 30. Imagine I am standing now at the end of first year and preparing financial statements. In my P&L, I book an expense of 30. Do you think income tax fellow will allow this? Get lost. Disallow. Why will he disallow? He says that what benefit did you pay to the employee in the current year? You did not pay anything. Look, a notional dummy entry. What is the entry you wrote? Employee compensation expense account debit to SBP reserve. Employee compensation, you put it in P&L and correspondingly, did you create a liability? No. The reserve, it is like transferring profit from P&L account to general reserve. If you transfer profit from P&L account to general reserve, will anybody give deduction for you? No, income tax or dummy entry, sir, I will not give you any deduction. Fine. But income tax fellow will also say that in future, once the options are vested, if the employer really exercises the option, at that time, even though market price of the share is 500 rupees, you are offering the share to the employee only at 150 rupees as promised originally. At that time, really you are giving a benefit to the employee. So we will give you a deduction, not now, when the options are exercised by the employee. Correct now? That means what? Even though today this is disallowed, in future it is allowed. In future, when is it allowed? When options are okay, sir. Future law you will allow. Fantastic. How much allowance will you give me? Tell me, sir. Whatever fair value 90 rupees you worked out using Black-Scholes model and all, do you think income tax fellow will accept that? You know what income tax fellow says? Okay, this is the exercise date. What is the market price of the share? 500 rupees, sir. What is the exercise price? 150 rupees. Okay, so the benefit you are giving to the employee is 350 rupees. Take this as income tax fellow will not understand fair value of option concept. He says that market law share price 500, you are giving it to your employee only for 150. So the benefit given by you to your employee is 350. Take deduction of 350. This 350A, we also call it as what? Intrinsic value of option. Intrinsic value of option is only for understanding the benefit. We cannot do accounting as per intrinsic value. Ind AS 102 prohibits that. Ind AS 102 allows only fair value accounting, that too on the grant date. All that is fine, sir. Now ultimately what I should do? Simple. This is disallowed, but futurely it is going to be allowed. So you have to create a DTA. Sir, how much DTA I should create? This is the most trickiest part. Tell me, sir. Guess. 30 disallowed. Okay. Futurely he will allow. I'll create DTA. But futurely he is not going to allow 30. He is going to allow you some deduction based on market price of the share on the date of exercise. How will I know this today only? I will not know. So how much DTA will you create today? I will not know. So how will you identify this? DTA creation is correct. Amount? For that there is only one trick. Take this. Market price of the share at the end of year 1. Suppose market price of the share at the end of year 1 is 300. exercise price in the option. Let us say we committed 150. Work out intrinsic value of option at year 1. So the option worth is 150. The entire option ka worth. We are talking only about current year. Vesting period is 3 years. So allowable expense, of course, estimated basis. This is not true, estimated. For year 1 equal to 150 divided by 3. 50 rupees deduction you are likely to get. Even though 30 is disallowed, 50 you are likely to get. So how much DTA can create? DTA is equal to 50 into 30% into the grade charge. Or this kind of detailed ESOP question, I say study matter not there. IFRS exam 2 times came. There are so many IFRS questions which later on came into CA final exam. They will not give hint in RTP, MTP always. Sometimes they will give. Sometimes directly shocking. It is one such shock absorber for you. Understand this? Concept book I wrote the story. Question if it comes, remember this. Till there clarity is there. Wait, story not over. Tell me DT entry. Half I will tell you if you want. DT account debit. Credit where? You will get Oscar award if you do like this. Why is OCA coming? ESOP is recorded in OCA. Yeah? OCA you should not post items whatever you feel like. OCA, whatever is given there, no, we should study that. We should not create OCA items newly. Come on, sir. ESOP is long term, 3 years or 5 years. So vesting period will be over. Ultimate clarity will come. Now, why do you think standard will ask you to put it in OCA? Come on, here. Okay, look at this. 30 rupees expense, where did you book? PRL, EC to SBP reserve. IEC will go to PRL, employee compensation. 30 rupees you booked in PRL. Income tax fellow disallowed. Because of that, you pay higher current tax. A current tax is accounted where? PRL only. So DTA also should be created via PRL. But the problem here is the higher tax what I paid versus the deduction what I am going to get, they both are not same. Higher tax, how much did I pay? 30 rupees disallowed, 9 rupees I paid. But deduction what I am going to get in future is not 9, 15. So see the entry. This is to the extent of extra tax what you paid, this will go and compensate that. Extra 6 whatever you are getting, no, that is pakka gain for you. And this is a gain relating to ESOPs, which is a own equity instrument. This portion will go into any gain or loss relating to own equity instruments cannot come into PRL. It has to go into other equity. All logically will go. It's deep surely, but this is maximum. Earlier we have seen DTA created via PRL. We have seen DTL created via revaluation surplus. Now we are seeing DTA DTLs created via retained earnings. Other equity law also it can be coming. It can be coming anywhere depending on what is the reason for the DTA DTL. Here, sir, in our country, no, sir, Income Tax Act is very strict, sir. Now they are disallowing. Future law also they will disallow, it seems. They will never allow. The most easiest case which will never come in the exam. Disallowed. Future law also never allow. And will you ever pay lower tax in future? No. So there is no DTA. Simple. A case will not come, sir. That's why do not create it. Possibility 1. Possibility 2 is this. Okay. Income Tax Act law. You understand there is something called as MAT provisions. MAT. When will you apply MAT provisions? Okay, I will not go into that 115G. Simply I will tell you quickly. Sir, your normal taxable income is 40,000. Tax rate is 30%. Current tax or simply tax as per normal provisions works out to 12,000 rupees. When your current tax is so less, income tax fellow says, "Arre, you should also compute tax as per MAT provisions applying 115 JAJB. There, you will have to first compute something called as book profits. Let us assume for convenience book profit is 1 lakh. And income tax fellow has got some MAT rate. It's 18 point something chiller, leave it. For me, this is easy, I'm doing this only, 15%. So, minimum alternate tax amount comes to, then they will compare. If MAT amount is higher, they will ask you to pay 15,000, ignoring this 12,000. But this is cheating, no? In a way, sorry, in a particular year, I really did not do business well. My taxable profit is less. I have to pay less tax, no? But income tax fellow says, no, you should pay 15,000. But I extra tax whatever you paid, that they will give it back to you in future whenever you again pay tax as per normal provisions. Yep. So ultimately in the current year, how much you have to pay? 15,000. But since you pay this, you will get a MAT credit, is excess tax paid, 15 minus 12, which is how much? 3,000. Now look at the accounting part entry. PRL account debit to provision for a tax. This only we call it as current tax liability. The debit portion is only called as current tax expense. Okay, this amount is recorded with what amount? 15,000, because this is my actual tax what I am supposed to pay for the current year. But I know that even though I booked expense of 15,000 now, 3,000 will come back to me on a future date. So the entry, again one more entry you have to pass. What entry we should write? MAT credit entitlement. This is an asset because it's a kind of a prepaid tax what we did. 1,000 to PRL, because separate asset you have to create. Am I clear here? Now, what our standard says is this MAT credit entitlement is also a kind of a future tax benefit only, that is coming because you paid higher tax in the current year. So you can describe this also as a taxes. This also you can describe it as a deferred tax asset, because DTS how will you get? Because you pay higher tax in the current year, subsequent year you will get tax savings. No, it is also something similar. So MAT credit entitlement also will be described as a clear ma? So this is all that is there. Is already covered, sir. Offsetting. Offsetting principles are very simple, sir. You have, for example, for a particular year, you have current tax liability and a provision for tax, 10 lakh rupees. But in the current year, 4 times you paid advance tax. 4 times only, no? 3 times, sir. Those are the income tax act. Okay. Provision for tax is 10 lakhs. 4 times we paid advance tax, which is 6 lakh rupees I paid. While receiving money, some stupids deducted TDS and paid me money. A TDS receivable is also there, 2 lakh rupees. So provision for tax liability 10 lakhs, advance tax 6 lakhs, TDS receivable 2 lakhs. So tell me, sir, on a net basis, how much tax I have to pay? 2 lakhs only. Will I go and pay 10 lakhs and claim refund for this entire thing? No. I'll have to pay net to 2 lakhs only tax. So when anyway you are going to pay ultimately net only, why to show them separately in your balance sheet? Offset them. Presentation law offset. Provision for tax 10 lakhs. Asset side, whatever advance tax TDS receivables are sitting, present them as a reduction from the provision for tax account and show net current tax liability only as 2 lakh rupees. Clear, sir? This is about offsetting current tax liability and current tax assets. Same to same is there for deferred tax asset and deferred tax liability. Here one extra rule that is given is DTA DTLs you can present on net basis only if the taxes levied are by the same governing authority. For example, there is only one income tax authority, no sir, what joke this is? Not like that, sir. See, I am exempted. I am in India. I have a subsidiary, she is in Japan. Her books DTA is there because of their local tax regulations. In parent company books, DTL is there. Consolidated balance sheet, DTL also will be there, DTA also will be there. But the DTA is created by some other tax law, DTL is created by some other tax law. Do you think I can offset now? I cannot. You understand, sir? If they are levied by the same taxation authorities and it will be settled ultimately anywhere on net basis only, no problem, you can offset 10%, otherwise don't offset. In the examination questions, whenever you see DTA details, question of data IM reversal, DTA detail, and if you see anywhere, just shut up and net presentation only you should do. Consolidation sums, business combination sums flow, you will be seeing in the balance sheet DTA or DTL. Again, while solving some extra DTA, DTL also will come. DTA what you are getting, and already balance sheet whatever DTL is there, you compulsorily have to do net presentation only. You cannot say that is different country, I will assume. No sir, nobody will listen to anybody. Any assumption, nobody cares. People who correct your papers most of the times are half brain people. They do not know full concept, they only know ICAI answer. If it is matching, they will give marks, otherwise you simply have to feel bad for yourself later on. So don't take any risk. Examination law, consolidation problems, business combination problems, whenever DTA details are there, separately you net it off. Although there are few cases where netting is not permitted, but our particular cases don't apply that rule. Come into small disclosure point. That's all guys, we are done with your IND AS 12.